Should you invest part of your emergency fund? Most people are making the same mistake with the emergency fund, either keeping way too much cash sitting idle, earning almost nothing, or investing money they absolutely cannot afford to lose. And both are financially inefficient, dangerous results. The reality is this: a fully cash emergency fund made sense when savings accounts paid nothing and markets were cheap. But today, inflation silently destroys that idle cash, while high interest rates and modern investing tools have changed the equation. So the real question really should be, should any part of your emergency fund actually be invested? And if yes, how much? And that's what we're going to talk about today. And I will share my own perspective about this question. So first, let's define the purpose correctly for the emergency fund. Your emergency fund is not an investment portfolio. It's not designed for growth, and it is a liquidity shield. That's it. Its purpose is to prevent a temporary financial problem from becoming a catastrophic one. So things like losing your job, sudden medical expenses, major car repairs, boiler breakdowns, family emergencies, and unexpected housing costs. The emergency fund exists to buy you time. And that's it. But here's the issue. Financial advice online has been oversimplified, and people hear keep 6 months of emergency funds or keep 6 months of expenses in cash, but nobody actually asks the questions: what kind of job do you have? How stable is your income? Do you have a dual income? How quickly could you replace your income? Do you have any children, any dependents? What's your monthly burn rate? Do you have access to credit? A software engineer with high savings, no kids, and a strong job market is not in the same risk category as someone with unstable hourly income and dependence, yet both are often given the same identical advice, and that's lazy financial planning. Now let's talk about the hidden cost. Now, cash feels safe because the number doesn't fluctuate, but purchasing power absolutely does. Inflation is effectively a guaranteed negative return. If inflation averages 3% annually, then over 10 years, £20,000 in idle cash loses a massive amount of real purchasing power. And that's before considering opportunity cost. Historically, diversified equity markets have outperformed cash by a huge margin over long periods. And if someone keeps an excessively large emergency fund in cash for decades, they may be sacrificing hundreds of thousands in long-term wealth creation. And that's the part most people never calculate. The problem is psychological, and humans often confuse volatility with risk. But permanent erosion from inflation is also risk. A portfolio dropping temporarily by 15% is visible, and cash losing purchasing power slowly every year is invisible, and invisible losses feel safer. Now, here's where nuance matters. If I'm not saying invest your entire emergency fund into stocks, because that's reckless. Emergencies tend to cluster around economic downturns, meaning the exact moment when you lose your job, you may also find that the markets are crashing. And that's a sequence of risk exposure. However, there is a strong argument for a layered emergency fund strategy. Instead of a one giant pile of cash, you split your liquidity into tiers. For example, you have the first tier, tier 1, which is 1 to 2 months or even up to 3 months of expenses fully liquid in cash, and this handles immediate emergencies. No volatility, there's instant access to this money, you're covered. Now, tier 2 would be another 2 to 4 months in low risk assets. So maybe your 3 to 6 months emergency savings are in fixed high yield savings accounts, money market funds, short term treasury bills, or premium bonds, depending on what you decide to do. Now, tier 3 would be where you have excess reserves invested in diversified index funds, for example, that kind of money that is there for the 6 to 12-month gap. You might be older, in which case you want to keep your emergency fund fully as liquid. But if you're still earning income, you might want to consider that third tier where your 3 to 6 months emergency savings are invested in index funds. This would be particularly pertinent if your income is stable, you have stronger cash flow, you have low debt, and your expenses are flexible, and you have a dual income household to support you or somebody to depend on. Even if you are a SINC, which is single income no kids, this might be the actual tier where you prioritize letting that long-term emergency fund do a little bit of work. And this structure increases capital efficiency without leaving you dangerously exposed. And that's the key distinction. We are optimizing resilience and not maximizing returns. So who should not invest part of the emergency fund? Now let's just stress test this, because this strategy is not universally appropriate. You probably should not invest part of your emergency fund if your income is unstable, you live paycheck to paycheck, you have high interest debt, you work in a cyclical industry, you have dependents relying entirely on your income, you panic during market volatility, and you have a history of selling investments emotionally. This matters because financial strategies only work if behavior matches the strategy. An emergency fund is partly mathematical, but it's also psychological. If investing part of your emergency fund causes you anxiety or leads to panic selling during downturns, the theoretical optimization is irrelevant. Your system failed. And there's another mistake people make. They assume emergency funds are static forever, but risk changes over time. If you are single, perhaps 36 years old with low expenses, and low needs, you have a different setup than maybe a 48-year-old parent with a mortgage and children. Your emergency fund should evolve with your life circumstances. So here's a more rational framework. Ask yourself 4 questions. Number 1, how fast could you replace your income? If the answer is quickly, you may need less cash. If replacing your income could take 12 months, you probably need more liquidity. Now, question 2, how volatile is my industry? Things like tech startups, commission sales, construction are more cyclical than government employment or healthcare. And number 3, what are my mandatory monthly expenses? Not lifestyle spending, but the mandatory obligations like your mortgage, utilities, insurance, food, and debt. A bloated lifestyle massively increases the required emergency reserves. And then question number 4, how emotionally resilient are you during downturns? And most people overestimate this. Everyone claims they will buy the dip until they watch their portfolio fall 30% while facing job uncertainty. Your emergency fund strategy should assume realistic human behavior, not fantasy behavior. So the question is, what do I personally do? I consider myself to have a somewhat stable income, to have a strong savings rate, relatively low fixed expenses, and no high interest debt, and consider myself to have a long investing horizon. So I don't think I would keep 12 months of expenses entirely in cash. What I have decided to do was to obviously have 3 months of immediate liquidity in cash, but I am investing my 3 to 6 months medium term reserves in low risk index funds, just to make that money keep working. Because I believe that idle cash has a long term cost, and if my financial situation became unstable, I'd increase the cash reserves immediately, and that's the point. Financial planning should be adaptive. It's not dogmatic. And the internet loves absolute rules because they're easy to package into short-term content, but real wealth building is more conditional than that. So here's the takeaway. Your emergency fund has one job: to keep you financially alive during uncertainty. But beyond a certain point, excess cash holdings can become economically inefficient. The optimal strategy is usually somewhat between invest everything and keep massive amounts of idle cash forever. So your structure should reflect your income stability, your risk tolerance, your dependence, your career resilience, your debt level, and your psychological behavior under stress. Now, if you found this video useful, please don't forget to subscribe to Sync Wealth. We are not professional financial advisors, of course, so please do your own research before you take everything we do as law. But let us know in the comments, how many months of expenses do you personally keep liquid? And I'm curious to know where people actually stand. Till the next video, bye-bye.